Welcome to our presentation. Do you like donuts? We love them. That is how we came across with the article that we will talk about today. Krispy Kreme Donuts is an American global donut company and coffee house chain, which was once a glamour stock with a 60% earnings per share growth rate and a multiple to match 70 times trailing earnings. Okay, now how pretty are those earnings? Looks good, right? But not really. Just a few months later, the stock fell down by 72%. This goes to show that judging earnings by simply looking at the figures is not effective. The quality of these earnings needs to be evaluated. What investors should have thought before taking a decision according to these figures? Francis and Tal provide insights to answering this question. The main objective of their research is to test a positive association between earnings quality and cost of equity. Specifically, the authors investigate the extent to which favorable values of 7 earnings attributes are associated with benefits in the form of a lower cost of capital. These are the 7 earnings attributes. The first 4 attributes are labeled as accounting-based because they are defined using accounting information, and the last 3 are considered as market-based because they are determined by using market data and accounting data. We will look at each of these attributes individually with respect to earnings quality. Accrual quality describes how earnings map into last, current, and next period cash flows, where earnings that map more closely into cash are preferred. Persistence relates to the recurring nature of earnings. Predictability is the ability of earnings to predict itself. Smoothness refers to removal of transitory fluctuations in the reporting earnings number, which leads to a more representative earnings number. Value relevance is the capacity of earnings to reflect variation in returns. Timeliness and conservatism, the last 2 attributes, are referred to as transparency. In order to test the impact of earnings to the cost of equity, Francis and Tal investigate first the prediction that more unfavorable values of the earnings attributes are associated with higher cost of equity capital. Second, which earnings attributes matter most to investors, by comparing the relative magnitudes of the cost of equity effects across attributes. And third, whether earnings attributes have distinct cost of equity effects, by testing for conditional effects of earnings attributes. How did they perform their analysis? The research method is based on annual cross-sectional regressions for approximately 1,500 firms per year over a sample period of 27 years from 1975 to 2001. We can differentiate 2 important parts in the research method. First, the authors test the association between earnings attributes considered individually and their proxies for the cost of equity. And secondly, they perform conditional tests by including all 7 earnings attributes plus known risk factors and innate characteristics of the earnings attributes. What are the key findings? First, when the earnings attributes are considered individually, they are significantly positively associated with the cost of equity capital. This means that firms with the least favorable values of each attribute have higher cost of equity. However, there are 2 exceptions, predictability and conservatism. Nevertheless, when controls for innate determinants are included in the regressions, the strength of those relationships is reduced. Moreover, the effects associated with accounting-based attributes exceed those of market-based attributes. Among the accounting-based earnings attributes, accrual quality has the strongest effect on cost of capital, followed by persistence and smoothness. However, among the market-based earnings attributes, only value relevance is associated with the cost of equity. Why this research is important? The above findings can have practical value to different readers. Earnings attributes have a meaningful influence on the discount rates for investors. It can also help regulators in devising different laws and regulations. The accounting-based attributes have a stronger effect on the investment decision, which is useful for researchers. Lastly, it also indicates to managers what factors affect cost of capital and also highlights to them the importance of improving earnings quality. Thank you.
Created using Powtoon.